Corporate Finance Core Topic 7, Cost of Capital, Learning Objective number 4. We're going to compute WACC and use for stock valuation. So in the last couple topics, we introduced the concept of the weighted average cost of capital. We then computed betas and cost of equity using the CAPM model. We came up with a cost of equity for Walmart using the CAPM model as 564. And then in the last topic, we determined there are several different methods for calculating cost of debt, and we're going to use 387, which is the average yield on AA rated firm debt. So I'm going to use that information and then also use Walmart's current DDE ratio. They have equity of $340 billion, net debt of $66 billion. So I just take the ratio of 66 billion over 340 plus 66 would be my debt percent, and 340 billion over the sum of 340 and 66 is the equity percent, and we're going to calculate the weighted average cost of capital. So let's go to the spreadsheet. So again, notice I have a formula for equity percent, which is E over D plus E. And I could have done D over D plus E for debt percent, but I just took 1 minus the equity percent. So now I can calculate my cost of equity, my WACC. That's going to be my cost of equity, 564, times my equity percent, plus my cost of debt, 387, times 1 minus the tax rate, since debt is tax deductible, times the debt percent. So the weighted average cost of capital for Walmart is 519. The assumption is Walmart uses unlevered betas for the industry, levered up by their DDE ratio to calculate cost of equity. I'm assuming that the current risk-free rate is 1.95% and a market risk premium of 6. And to get my cost of debt, I assumed the average rate on AA rated bonds. And I used a last year's average tax rate of 25%. So on average, debt holders demand 387, equity holders demand 564, and the weighted average of those numbers, adjusting for the tax shield, is 519. So if Walmart borrows money acquires money through debt or equity, the weighted average is 519. So now we're going to use that information to then value their stock. Oh, by the way, let me just show you something that's very important. Sometimes you're not given the D value and the E values. Let me go back there. The D values, you might just be given a DDE ratio. I want to show you that the DDE ratio is not the same as the debt percent ratio, right? So D over E is not the same as debt percent. The debt percent ratio is equal to D over D plus E. But however, there's a simple way to convert a DDE ratio to a D percent ratio. You just take your DDE ratio over 1 plus the DDE ratio, and that will convert it to a debt percent ratio. So Walmart has a 0.19 DDE ratio, and if I divide the DDE over 1 plus the DDE, I get 0.16, which is their debt percent from calculating it directly. So now I'm going to use that to value Walmart's stock, kind of going back to topic 4. Remember topic 4, I just kind of punted on the choice of discount rates. I just said I'm going to use 6% to take the present value of dividends, and I'm going to use 6% to the present value of free cash flows, and I got valuations. Now the appropriate discount rate for dividends, since dividends are simply a cash payment to shareholders, the appropriate discount rate for dividends is just the CAPM cost of equity. It's not the WACC. Now, the free cash flows of the firm, these are cash flows available for both shareholders and bondholders, so the appropriate discount rate to use for them is the weighted average cost of capital. Now, when I value these stocks, what I'm going to do is I'm going to take the present value of either dividends or free cash flows, and that's going to be called my stock valuation, also sometimes called the intrinsic value. I'm going to then compare that to the market price of the stock I see on the internet that's trading on, say, the New York Stock Exchange. And if my valuation is greater than the market price, then the shareholders are getting a great deal, or that's the stock I should buy, one in which my valuation is greater than the market price. So if I just go back to my models, I'm not going to go into them because we've already done these models in topic 4. The only difference is where I used to say 6% as the discount rate. Well, now for the dividend discount model, I'm going to plug in 564, which is what we used to calculate the WACC. That's from the CAPM model. So that's the cost of equity. Whoops, let me go back to where we were. So I'm going to use the 564, and I take the present value of dividends at 564, and I get a $68 stock price. I then go ahead and use the free cash flow to firm, the DCF model, the discounted cash flow model. And I don't take the present value of dividends, I take the present value of free cash flows, discounted at the weighted average cost of capital, WACC, and I discounted at 519. And then again, remember that model, there is 2 ways to do the terminal valuation. I can either use a constant growth perpetuity, or I can use a EBITDA multiple. So when I do that, I get different values. So using that, Walmart's either worth $199 or $206, using that WACC of 519. So that's how you use, well, that's how you calculate a discount rate to use to value a company. And again, I mentioned that no one generally uses the dividend discount model. People are generally using the free cash flow model, and you're going to discount those unlevered cash flows at weighted average cost of capital. And also, it should be noted at this point, in free cash flows to the firm, nowhere in free cash flows to the firm is there interest expense, because I'm taking my EBIT after tax. So I'm not accounting for interest expense. So when I did that valuation, and when I talked about FCFF, free cash flows to the firm, I said we're going to handle the fact that the firm has debt and the impact it has on the valuation of the stock in the weighted average cost of capital. And then, so this completes that thought, that the cash flows do not include the effects of debt. The effects of debt are in the weighted average cost of capital, and that will have an effect upon the valuation. So, so we computed WACC using our formula of KD and KE and equity percent, and we used it for stock valuation, discounting dividends at cost of equity or discounting free cash flows to the firm at the weighted average cost of capital.